Welcome to Sovereign Finance, the show that connects the dots between personal finance, global finance trends, and deep human history. Tune in every week to demystify the money puzzle and protect your interests in a turbulent world.
Welcome to the Sovereign Finance Podcast. I'm your host, Rob Drummond, here with Derek Dearden. How's it going, Derek?
It's going great, thanks, Rob.
Our topic today is capital and capitalism, which feels to me like a big, hairy topic. So where do we need to start with this one?
Right. Well, last week we were talking about wealth and what wealth is. And I put forward the suggestion that we should regard wealth as meaning things that people want, therefore things that they therefore value, and that they're prepared to they're prepared to trade to get wealth created by other people. And we looked at the fact that essentially wealth is either created by the activity of working on something, and then the things that are created can be traded for something else. Now, that's obviously very broad, and there's a particular form of capital of wealth which is described as capital, and in this talk we're going to unpick in a bit more detail what that actually means, and then obviously we'll see how that applies to investments you might be making, or arrangements for funding a pension later in life, and also to look at it from the point of view of if you're an entrepreneur, what it means to you to have capital. And obviously we have this system called capitalism, and it's common ground amongst just about everybody that it's not working terribly well at the moment. And so what we're going to have a quick look at is whether that is something inherent in the, the nature of capitalism itself, and if so, what the alternatives are, or whether it's simply a reflection on the form of capitalism that we have created in the world at the present time.
I think it works very well in some regards. Like it works very well to increase efficiency. It works very well to get us producing lots of stuff.
Yeah.
But there's no regard for the implications of all of that.
Yeah, we'll be exploring all those kind of ideas as we talk, and we'll round off by whether capitalism as a system or something else lies in the future. But either way, what might be possible for something which serves us and serves humanity generally and serves the planet and the ecosystem. So,
I mean, the word capital itself makes me think of two things. The first thing it makes me think of is a Charles Dickens novel and like these big factories and machinery where, you know, you've got small children operating these machines. So it makes me think of that. It also makes me think, like, in my business, I have precisely one share in the business that is worth £1. That is on my balance sheet. So that's the other thing it makes me think of. So they're two quite different things, I guess.
right. Well, that's actually quite a good jumping off point for a little bit later in the conversation, when we think about what is meant actually by shares in the business. And plainly, in the case of you're having a limited liability company that you use to operate your enterprise, and you've created it in that form, and you have one share. This is something of a fiction of what the whole idea of having shareholdings in an enterprise was in the first place. But there's essentially two ways of thinking about capital, and the most common one is where we're thinking of it in terms of financial assets, part of your portfolio. You might have stocks and shares, you might have bonds, you might even have rental property or something like that. That would all be regarded as your capital. But then let's unpick what those shares and what those bonds represent. Of course, the whole point of having those is to get a return on them, which will accumulate over time, and eventually you'll become wealthy. And I think most people who have any kind of pension plan, whether their employer has provided it or whether they're investing in their own, they're expecting that the time is going to come when the plan matures and it's going to yield an income, and that income is going to be enough to live on and support them in their twilight years.
Yeah, that's not going to happen for me. No, I'm going to get to 50. I'm going to take a big tax-free lump sum and I'm going to do something nice with it. And we'll figure out plan B.
Yeah, well, exactly. I mean, in fact, virtually everybody I know who has a pension plan and who has been paying attention to the way it's developing is coming to the conclusion that it's not going to deliver the goods. And that's an important enough topic that I think we'll have a future episode unpicking that entirely. But let's have a look at the principles that are involved, because there was a time up until about 40 years ago or so when the pension system was actually working pretty convincingly for most of the people in it. Most of the people who were working in a good job for a sound employer for a working lifetime were paying into a system which they didn't really think about because it was entirely automated, came out of their pay packet before they even thought of it. And this was invested in a fund which did indeed provide them with an income. And we'll look at in a bit more detail later at the mechanism of that. It did provide them with an income which would serve them for the rest of their life, and typically that was 2/3 of the final salary that they were earning. And when I was working in the firm of stockbrokers in the City of London 50 years or so ago, that firm specialised in investments for pension funds and life insurance companies that were doing that, and the system was working. People got to the end of their working life, they retired, they had 2/3 of what they'd been earning up until now. Most of their big expenses had been paid, and that was perfectly enough to live on. And as I say, when we do one when we do an episode specifically on the way that the pensions work and the way they are now failing to work for the most part, and some of those failures are going to become more and more apparent over the next few years. But the principle of it is that over the period of a lifetime, there is an income generated by that capital, and that income is then reinvested in the fund, and so it grows exponentially. And the calculations are such that in times gone by, it genuinely did generate a big enough fund that could then buy what's called an annuity, which is like a reverse, the reverse of a life insurance policy. Instead of paying in premiums, and if you're unlucky enough to die, your dependents get a big lump sum. An annuity is the other way around. You pay the insurance company a lump sum, which is what's been accumulated from the pension fund, and they decide, depending on what the statistics are of how long you're likely to live, what they can pay out such that their books are balanced, and it lasts long enough. And obviously, some people live a shorter length than average. Some people live a longer one. But this depends on the real exponential growth of the value of the fund. And the question is, where does that income come that can be rolled on and generate this growing return. And broadly, there are two types of investments. One is shares, stocks, equities, as they're called, whereby you have a part ownership of the company. And the other one is bonds, which effectively are loans from you, the investor, to either a company if it's a corporate bond, or to the government if it's a government bond. And the government pays interest on that out of the tax revenues that it raises, in theory, and the corporation pays the interest from its profits, and in general that has the first cause. Now, if you to the extent that you have shares, it's not just the fact that you have dividends uh, paid into the fund, it's also that the shares themselves might appreciate in value over time. And once again, when we discussed inflation and so forth, we saw how difficult it was to distinguish genuine growth in the value of your investment from merely larger numbers that are given by the debasement of the currency that it's measured in. But let's roll that back. How does the company pay either those interest fees or those dividends? Essentially, it does it by operating at a profit, and it operates at a profit by selling the goods or services that it produces for a larger sum than the costs involved in providing them, plus the overhead expenses of the business. And the difference between the two is the profit. They might distribute all of that profit to the shareholders in dividends, or they might distribute some of it and reinvest the other in expanding the business. Or if it's particularly if it's a high-tech operation in its early stages, it might not pay dividends at all. It might reinvest it all, and the shareholders are entirely expecting to get their return by the increased value of the company as a result, which comes back down to looking at it perhaps from the point of view of a small entrepreneur such as yourself. If we take an example that we had in one of the previous episodes of somebody who is running a small business as a carpenter or furniture maker, their profit comes from the difference between the planks of wood and glue and screw and nails and things that they buy to manufacture the furniture, and the price that they can sell the furniture for. And then over and above that, they have to pay their living expenses, the cost of a vehicle to run around and do collections and deliveries, the workshop premises, the machinery, and so forth. So the capital in terms of equity shares in a corporation is actually represented by ultimately the ownership of what the business is holding in order to run its operation.
And surely some businesses are more capital intensive than others. Like in my business, I kind of just have like a laptop, a microphone, and good to go.
Exactly. I mean, if you've got what is essentially an information business, as you correctly say, you need very little in the way of capital.
I'm convinced I need a motorbike, though. I definitely need a company motorbike, which apparently is a capital allowance as plant and machinery. So,
Yeah, fair enough. I mean, after all, you might have to go and visit clients. You
correct.
need a motorbike to
Get there
visit them
to
on.
get there extra fast. Yeah.
Yeah, I had a motorbike as my principal means of transport for many years, and some of my clients were extremely amused to have me coming in for their meetings with their directors dressed in my leather jacket and jeans.
Well, it makes a statement, doesn't it? It's like a start as you mean to go on statement. Yeah.
Yeah, yeah. I mean, I got a lesson in the necessity of playing the game to the extent of projecting the right image once when I went in to a company and asked to see one of the directors and the receptionist. I mean, it was a company where I was pretty well known because they were a regular client, but they'd got a new receptionist who looked at me a bit quizzically and said, "Are you the decorator?" Anyway, Rob, as you rightly said, a lot of businesses can be started up with very little. A computer and an internet connection and a printer will go a long way with a lot of businesses, and so there is no need. Which comes back to why it's a bit of a fiction that you have shares, because the principal concept of shareholdings in an enterprise was that it was to solve the problem of how you get the capital in the sense of the material stuff and objects and machinery and whatever else you need in order to run the business. If you go back to the heyday of the years of the Industrial Revolution, typical business might be, say, a steelworks or a railway line. I mean, if you think about a steelworks, you need blast furnaces, you need rolling mills, you probably need cranes, you need trucks, and so on. All of that costs a lot of money. That's got to be acquired one way or another before you can start running the operation and generating goods that you're going to sell and generating an income. I mean, the other big example would be railways. You've got to negotiate way leaves across a number of landholders' holdings. You've got to uh, have gangs of men digging cuttings and uh, piling up embankments and laying tracks. You've got to build stations. You've got to acquire locomotives and rolling stock.
I think it's worth remembering that much of the UK rail network was built through private investments in the Victorian era,
Exactly.
in a time when blasting through hillsides was more acceptable, and you could just do these things. I guess.
Well, I think the railways were all entirely private companies before they were nationalised by the Labour government just after the war.
And that's why you had like stations like St Pancras and King's Cross like right next to each other because it was a different rail company that needed a terminus in London.
That's absolutely the case, yeah. And so, in order to acquire that capital in the sense of the machinery and stocks, the money had to be found to either make it or buy it from somewhere. And that was acquired by getting a number of people who had some kind of financial wherewithal to become joint owners of the company, and that's why these are called joint stock companies. So it might take, £100,000 in the 19th century to build a steelworks. You wouldn't get very far with £100,000 these days, as we know, because of the debasement of the pound. But it might take £100,000, and you might have a whole bunch of people who put in £1,000 each. You might have a few who put in much more than that. You might have a much larger number who put in less than that. So they're the shareholders. They're the owners of the company. That's referred to as equity shares because the equity in the company is what they see on the balance sheet, is the difference between the assets and the liabilities, and that is the equity in the company, just as the equity in your house is the difference between the current value of the house and the balance still to be paid off on the mortgage. And so they each have an ownership of that proportion of the company.
And presumably someone would have like a controlling stake.
Well, there may be a single individual who's got more than 50% of the company, but I think that would be unusual. I think it's far more likely that it would be distributed over a number of people who, as I say, might have larger and smaller shares in the operation, but no single individual being able to control it entirely. Although in some cases, uh, it was deliberately set up, perhaps so that the founder had a controlling share. The and that also is the reason why there would be an annual general meeting of the shareholders, and at that meeting, the shareholders would vote on various things. One is they'd vote on who is going to serve on the board of directors, and another one is who they're going to appoint as the auditors. And effectively, the shareholders vote on that, which is a kind of fiction in the case of an operation like yours, where you have to have a meeting once a year, and you as the one and only shareholder.
I go to the pub, I buy a beer, I appoint myself in all of the roles except auditor, which
Yes.
remains vacant. And
Yeah. So, but in the case of a steelworks, uh, probably in most cases, none of the directors would be actively involved from week to week or month to month in the running of the company. They would hire managers who would do all that, and the directors would be responsible for setting the objectives that the management had to aim to fulfill on, and monitoring whether they do or not, and what to do about it if they don't. And so it's logical that those would be appointed by the shareholders because it's the shareholders' interests that they're looking after. And in fact, as a general rule, it would be very unlikely that they would appoint any directors who are not shareholders. Um, they would choose somebody from amongst their own ranks who was prepared to put in the necessary time. Occasionally, they might appoint an external director who's got some special expertise in the area that the company is operating in. But in general, various shareholders put themselves forward as director candidates, and the other shareholders would vote on that, and they'd be able to vote in proportion to the number of shares that they hold. And we'll have a bit of a look a bit later on at the way this works in practice these days, because obviously the majority of shareholders, if they own it, if they're direct investors in a big corporation, like British Leyland Motors or something, they are either such small beer that their votes won't count for much, but the majority of the shareholders will be holding them indirectly through their pension plans or their life insurance policies and that kind of thing. And the people who turn up at the directors' meetings will be the representatives of the mutual funds, the life insurance companies, the pension funds, and so forth. And so they'll be the ones who appoint not only appoint the directors, but and then the directors in turn will appoint the management, which would include the chief executives and the chief financial officer and so on. And it's a mystery on the face of it why chief executives very often not only get paid totally disproportionate amounts of money, but have contracts which allow them to be compensated royally even if they fail and get kicked out. And you wonder how this can possibly be in the interests of the shareholders. And it may be part of unpicking the puzzle about why those pension plans are not really serving the interests of the members who are paying in their monthly annuity payments to fund them. Anyway, so I mean, let's take the case once again of the guy who wants to set himself up in business as a furniture maker. He's going to need some premises. He's going to need to probably be operating the business for a few months before he's actually got the sales and starts an income coming in. He's probably going to need a table saw of some sort, a planer, a router, a whole bunch of hand tools, and as I said, he'd probably need a van, and he's also going to need some stock in order to start work. So all of those things would be his capital. And unless he's already just had an inheritance from a rich family member, or he's worked for many years and been very frugal and uh, had a large saving, he won't necessarily have the wherewithal to buy those things. And he's basically got two alternatives. One is to find an investor who's happy to be a sleeping partner in return for a share of the profits. And the other is to get a loan, again, either privately from somebody he knows, and the arrangement, or more likely from a bank. But in either of those cases, if it's a loan, he's essentially entering into an agreement whereby they provide him with the funds to go and invest in the premises and machinery and vehicles that he needs to run the business, in return for him, in the case of a bank loan, normally repaying it on some pre-arranged schedule, or in the case of a bond, that the bondholder hangs on to it potentially indefinitely, and perhaps has the ability to sell it to somebody else in return for an agreed regular income payment. And there are all kinds of minor details about the way that might be set up. And of course, it's unlikely that in this example of a small scale entrepreneur that he's going to get anybody to be happy to be a bondholder. He may or may not be lucky enough to get anybody who wants to invest as a equity shareholder and as a sleeping partner. So it's more likely to be a loan from the bank or something similar.
He will more than happily magic the money out of thin air for him.
Yes, as we've discussed in another episode. Obviously, when we're talking about bonds, we're talking about large public corporations, and so that is an option for them. And we'll look in more detail in another episode about the way that differing capital structures would affect that. In that, obviously, if you've got what's called a highly leveraged operation, where you have a great deal of the money that you need to run the business coming from loans, and you need to pay that off, that takes a first slice out of the profits, and the shareholders have what's left. And if profits are very good, that means that the shareholders get a disproportionately large sum. But of course, that can go in reverse. If the profits are less than anticipated, by the time the bonds interest is paid, there might not be anything at all for the shareholders. It might not even be enough to keep reinvesting as equipment becomes obsolete and needs replacement and so forth. So obviously, the more highly leveraged the company is, the more risk there is of adverse economic circumstances being catastrophic. So I think that covers what we want to say for this point about what capital is in tangible terms and how it's acquired.
So as business owners, like, we all need some kind of capital to operate, and the nature of your operations are going to dictate what that looks like.
Absolutely, yeah, yeah. So let's look at capitalism, and probably the best place to start with this is, what is the definition? Well, the dictionary definition of capitalism is it's an economic system wherein the productive assets of the economy are privately owned. And clearly that is the situation. The majority of operations that we have in this country are owned by individual shareholders or by mutual funds representing the savings of a large number of people who invest in those companies on their behalf. Now, clearly, as I say, more or less anybody looking at the current state of the world knows that this is not working too well. The gulf between wealthy people and less wealthy is getting wider and wider all the time. A smaller and smaller proportion of the population are the holders of an overwhelming majority of the total wealth in this country and in most of the rest of the world. And the quality of goods is not improving, and the impact on the environment is, I think it wouldn't be too much of an exaggeration to say, catastrophic and going from bad to worse.
I mean, that's measurable in a few ways, in habitat destruction, the decline of insect populations. I think I think people get quite hung up on the climate change arguments, but when you look at it in terms of number of insects, I don't think it's debatable. Amount of pollution, air quality.
Well, if you're a motorcyclist, and you have been for any number of years, you'll know from first-hand experience you get far fewer flies landing on your visor in the summer than used to be the case.
They make a right mess as well when they smack into your visor at
Yes.
70 miles an hour.
I mean, it may seem like a plus, but we have no idea how many insects can be taken out of the ecosystem before it produces some kind of catastrophic network effect.
Well, it's the law of unintended consequences that always strikes.
Yeah, yeah. So, what are the alternatives? Well, if the means of production is not privately owned, the alternative is for it to be publicly owned, and that is what is described as socialism. And various forms of socialism have been tried, and the first thing to point out is that none of them have actually delivered satisfactory results. I mean, if it was the kind of mild form of socialism that we've had in this country, where the phone company and the rail network and the water companies and the electricity generators were all publicly owned, or whether it's the more extreme forms described as communism in the Eastern European and Russian bloc, they didn't actually deliver good quality goods and services at an acceptable price. Unfortunately, the solution of
There was no individual incentive for that to be the case. So.
yeah. I mean, to put it bluntly, the temperament that made somebody want to be a civil servant was not the temperament that would be ideal to make a good entrepreneur. So, but I think a more damning indictment of socialism is the fact that it was no better at things like reducing pollution or stewarding the environment or the ecosystem than the capitalists. I mean, in fact, there's a good case to be made out for the fact that the Russian communists were worse polluters than any capitalist economy had been. So that assumes that public ownership means ownership by the government on behalf of the people. And plainly, it didn't actually work out to be for the benefit of the people. And it didn't really work out that much better for the workers, too. I mean, uh, when, when they nationalised the coal mines, the, effectively the coal mine managers were the same people now employed by the government as had been employed by the landowners who previously owned coal mines. And they probably had very similar differentials in wages and in working conditions from the people who were actually going down the pit and digging the coal out as they had under the old system. I mean, there might have been minor and even very worthwhile improvements to the working conditions, particularly in the worse establishments. But it didn't solve the problem of the social inequality that was involved.
No, I mean, you've still got a problem of distance where the people who are ultimately responsible for managing these things are distant from the day to day realities of delivering that service or whatever it is.
Exactly so. But let's have a look at the different phases that capitalism has gone through. I would say that the first stage is feudalism. Now, according to Karl Marx, that feudalism was an entirely different system, and then capitalism came along, and it was something else. But I would say that if we go back to that definition, that the means of production are in private hands, feudalism was exactly that. The primary capital in an industrial economy, in an agrarian economy, is the land itself. And then there would be a certain amount of farm machinery and horses and carts and windmills and water mills and blacksmith shops. But the biggest part of the capital would be the land, and that was owned by the landowners, who were the descendants of the people who took it by force back in the day, and then established themselves and awarded themselves the credibility uh, of being in charge of things. So that was a form of capitalism in that sense.
I was thinking about the enclosures as you were talking then as well, and
Yeah,
that was all done under the narrative that the land is allegedly more efficient when you have these big plots and there's efficiency gains. And I
yeah.
think what actually happened was they destroyed the soil, but and didn't rotate the crops, didn't manure the fields.
So so anyway, then the Industrial Revolution came along. We started making spinning machines, weaving machines, steam engines, powered the factories with steam engines, made machines to make machinery. It's an interesting reflection there that the most sophisticated equipment we have worldwide industrially, you could trace its ancestry back eventually to something that somebody made by hand. The makers of the first machines were the descendants of the clockmakers and the locksmiths. Anyway, so this is the kind of capitalism that Karl Marx was critiquing, and uh, the dark satanic mills with the factory machinery and the steam engines belching smoke out of factory chimneys and the downtrodden proletariat.
That's why I mentioned Dickens at the start of the episode. Yeah, that's kind of what I was thinking of.
Yeah, yeah. And entirely justifiably, this was clearly a very unjust system, a very unfair system, a very brutal system with a great many losers.
Well, it forced people to move into cities and off the land because the
Yeah,
land had been enclosed, so they couldn't work the common spaces anymore,
no.
and it forced them to go and work in these factories.
Now, what I would say is that the next phase, which arrived in the post-war years and ran from roughly 1945 for 25 or 30 years up to 1970 or 75 was what I would call semi-functional capitalism. We got a situation where, although there was still a um, significant spread of prosperity across different sections of the population, which I think is something that we're always going to have. It's unrealistic to think that that will ever go away entirely. Um, but it was becoming more reasonable. The working conditions were getting better. People's general level of prosperity across the population as a whole was improving, and there was indeed, in the cliched phrase, a rising tide lifting all boats. Everybody was getting better off together, and that was the justification for the system. People had better working conditions. They had shorter working hours. They had income that would not only provide them with the basics of life, but provide them with luxuries, domestic appliances, motor cars, and as I say, in a lot of cases, pensions plans which provided comfort once they'd reached the end of their working lives.
Sounds great.
Yeah. And what we have seen, of course, in the past 40 or 50 years is a reversal of that back to perhaps far more extreme inequality, and as well as the other side effects we've looked at. So I would regard this as degenerate capitalism. And if we're not going to have socialism, which appears to me, for reasons I've already discussed, neither likely nor desirable, what's it going to look like? And what I would say, assuming that we manage to, as a human race, decide to improve our circumstances, is it would be, if you like, capitalism with a human face. We would still have the people who are operating enterprises to own them. There'd be perhaps far more formal cooperatives or worker shareholders arrangement whereby the ownership of the company resides to a substantial degree in the people right across the board who are operating it, not just the directors and managers. And is things are done on a human scale.
And I think it's worth focusing on like the big operations as well. Like how would they look? Because if it's a water company or a rail company, like it is a big thing. It's like it's not in the small business space.
Yeah, I mean, and if we're going to build ships or airliners or things, that is obviously not something that can be done in craft workshops. That's something to investigate and to explore the possibilities of. But it would certainly involve, if you like, groupings within that larger operation, providing decisions by consensus, including taking all of the responsibility for all aspects of it, not just the bottom line on the profit and loss analysis. And I think that comes back to the most severe defect of the current version of the system, which is that profits are seen as paramount. They're seen as the be all and end all of running the operation, and the delivery of what the operation is ostensibly there to do being a secondary consideration that can be optimized, to use the phrase, optimized for greatest profit rather than for highest quality goods or most satisfactory conditions for the workforce or uh, beneficial interaction with the wider environment of the planet and these other factors. I mean, the other thing is that we've reached a stage where it's very difficult for small operators to compete. I mean, if you go back to the time of my childhood, the shops up and down the high street in towns all over the country were virtually all owned and operated by
Local people.
by the people who were running them. Uh, any Anybody who trained as a baker or a grocer or a butcher or a greengrocer, if they were energetic and ambitious, they would expect by the time of they were 40 to be owning their own shop, to be employing a small staff, and to be making a comfortable middle class income from it. And we've seen the complete erosion of that to the point where now the shops down the high street in any town are exactly the same corporations the country over and to a large extent the world over. And the
Oh, it's different brands, but it's the same. It's the same entities that own them. It seems.
yeah, yeah. Although there are various inbuilt advantages to scale, there are also inbuilt contradictions and disadvantages. For instance, all these corporations require enormous bureaucracies to run that are not actually contributing anything directly to the delivery of the goods and services. And also, we see ridiculous diseconomies in terms of centralized locations and then trucks driving all over the country. 60 years ago, a lot of the produce in any town came from the surrounding area, whereas as now, even our milk might come from hundreds of miles away. That plainly isn't objectively efficient. And so I think this provides opportunities for a pushback of individual small scale enterprise in a lot of ways.
Because those arrangements are put in place for the benefit of the company, not for the benefit of the community that that shop is based in.
Yeah. And now the cracks are beginning to appear in the system, and one way or another, something else is about to evolve.
And I think when you look at these kind of brands, it's very difficult actually to figure out where the ownership is. Like even if you look at Google, you would think that Google owns Google, but that isn't actually the case. Like Alphabet is the parent company
Yeah.
of Google, and BlackRock and Vanguard have big stakes in Alphabet. So it's like, well, where is the ownership? It's,
And of course, BlackRock and Vanguard and State Street also have ownership of Microsoft and Apple and Facebook. And so these things are not in any meaningful way cooperating with each other. They also have substantial shareholdings in both Coca-Cola and Pepsi-Cola. So there isn't anything resembling genuine cooperation between those, whichever one you choose to buy.
it's almost like the illusion of choice, isn't it? It's like we're presented with this illusion of diversity and choice, and it's like
Yes.
when you peel the onion back, like it isn't really the reality.
I think that pretty much covers what we wanted to discuss today, do you?
Yeah, I think so. My only thought as well was like there's a growing there's a concept of it's inverted totalitarianism where in effect government ends up being kind of hollowed out and controlled by corporate entities, and there's maybe a feeling that that's happening to some degree at the moment.
And it's happening to an enormous degree.
Yeah, yeah, I was perhaps understating it. Yeah, I mean,
Yeah.
but that to me, if we try and get to the root cause issues, like we're saying that capitalism isn't serving us in terms of it gets us to produce a lot, but it doesn't create a fair society. It doesn't it's not going to lead to the long-term flourishing of human civilization. But we're also saying that socialism isn't a valid alternative. But if we're trying to get to root cause issues, it's like, well, I think you kind of have to look at like these at the nature of power and how that works, I guess.
Well, that's another topic for another day.
Yeah, it's more questions than answers, maybe. But you know what? I think one of the first things is just calling it out and raising awareness of it.
Yeah. Well, I hope that's part of what we're doing here.
We'll leave this one there. Thanks, Derek.
Thanks, Rob. Bye.
Thanks for listening to this episode of Sovereign Finance. For more episodes, transcripts, in-depth articles, and community, please take a minute now to subscribe free at sovereignfinance.substack.com. See you next time.